Obviously, the time frame for this window of the bull market, I think, is closing rapidly. I really expect the real economy to decelerate rapidly into 2023. So enjoy these next few months, because I think it can be a rocky seas into 2023.
Hey everyone, welcome to the show. I'm here with our mastermind group. Boy, these guys had some pretty good calls on the last show. They were expecting a bounce. I know Jeff was, Joe, Jay. I think you were a little skeptical like me as to whether what it was we were going to see into this quarter. But let's start off there. How are you guys feeling now based off of what you've seen? I'm curious. Go ahead and take it away. Whoever, step right up.
Joe, why don't you go?
Yeah, I'll go. So I think you have to be under a rock not to feel that the real economy is decelerating, right? Like every single leading metric shows that we're headed down here in terms of real economic growth. In terms of the markets, kind of we really have been in this huge range. I mean, we dipped down for a little bit there in the beginning parts of June, rallied quite a bit off the bottom. I think from our last episode on May 11th, the S&P is 5% higher. NASDAQ, correct me if I'm wrong here, Jeff, I think it's close to 10% higher from our May 11th episode. Virtually, even high yield credit has bounced a little bit since we last recorded and checked in with everybody. The only thing that obviously has been a kind of a mess has been the Bitcoin market, right? Bitcoin's tanked. I think it's about 20% from our last recording, but everything else has sort of bounced higher. I still think that we bounce a little bit higher here, but obviously the time frame for this window of the bull market, I think, is closing rapidly. I really expect the real economy to decelerate rapidly into 2023. So enjoy these next few months, because I think it can be a rocky seas into 2023.
So what do you think the driving factor for that peaking, this bounce that we're seeing right now? Is it just once the third quarter earnings reports start coming in, mixed with a whole bunch of macro factors, is what everyone's going to notice that it starts stalling out again? Is that what you're thinking, Joe?
Well, to me, to get the equities, and I've long said this, to get the equities to really roll over hard, I think you need to see unemployment really tick up, because passive investment plays such a massive role. I mean, people are just buying it reflexively every 2 weeks or a month. Whenever they get paid, those dollars hit the bank account and they bid up these things, particularly the SPY and the growth funds in NASDAQ. So, to really have a sustained drawdown, you kind of need those passive flows to disappear. And to have the passive flows disappear, you need unemployment to rise. Particularly, you need it to rise among the higher wage earners. So from my standpoint, I think that's what I'm looking at. I also think that the yields having peaked, and I do think they've peaked. That's my view. That it has naturally been a boon to the equity market. As yields continue to trend lower, there's rebalancing into equities, which has stabilized all markets. So the bond market really is the whole ball game. If the bond market is stable, equities can be stable. And obviously, during the first part of the year, the big headwind was that the bond market was a total disaster, right? We had a 4 standard deviation move, and that crushed everything. So for my purposes, as long as you've got relative stability in the bond market, you can get a pretty good run here in equities. But it is sort of a counter trend move to the deterioration in the real economy.
What do you think's moving to bonds from here, Joe?
Right now, at the long end, I mean, I think you got really two competing forces. At the short end, it's being held up by the Fed hiking, right? The Fed continuing to be aggressive all the way out to the 2-year. That is driving those yields up, or at least sustaining them a lot higher than they would otherwise be. I think that on the long end, you continue to see the flight to safety trade. I think you see people, finding safety in the 10-year, 20-year plus, the TLT type trade. I think that is going to be a force for the rest of the year. Really, people are positioning for very bad things economically, and that's what an inverted curve shows you, right? It shows you effectively that they think the Fed is hiking too fast, but the long-term economic growth is deteriorating. Therefore, there's some flight to safety in the long end.
So Jay, I was popping up a chart here, which I think is explaining exactly what Joe's saying on two fronts. So he's talking about the negative bond yield curve, which on the bottom of the chart, you can see the 10 minus the 2-year right now on 8 August is at a negative 0.45%. We haven't seen it that low since 2000 was the last time it got that low. And then in the 2007, right at the start of 2007, it got to what looks to be like a point, a negative 0.2 or something like that. So we're already lower than that.
By the way, Preston, did you catch the same spread in the Canadian bonds? It's the most inverted in history.
Oh, wow. I didn't know that.
Yeah, it's the most inverted it's ever been in the Canadian long bond versus their short end. So that's an interesting chart. We don't have that chart, unfortunately, but you can look it up. It's never been as inverted as it is now.
I might be able to create it while we're talking here a little bit later. I'll see if I can make it while we're talking and pull it up. The top line here that we're looking at is the unemployment. And Joe, you said something that I completely agree with moving into the end of this year, which is I think if we start seeing unemployment come from this 3.5% that we have displayed on this top line, if you start seeing that start tick up, I think you're going to see the markets get scared as hell. Just look at this chart when we had this negative spread. I mean, right there at the start of 2007, look at where it was at in 2000. And then think about the deepest part of the recession in 08. It was really kind of the summer of 09 is when I would personally describe it as like the darkest part of that crash. And look at this chart here. When you were like 2009 to maybe the start of 2010 is when you saw the worst unemployment numbers. And we are literally at the complete inverse of that right now, like you saw at the start of 2007. So
it's a great chart.
You see a lot of people, especially in the political realms, kind of beating their chest and saying, we have the best unemployment numbers we've had ever. But that has been that indicator has been the canary in the coal mine for in the coming 12 months. It's about to get nasty.
I was trying to find this chart, but I heard a guy on CNBC say a few weeks ago that even though we have like the low unemployment, people are working more hours, like double jobs and stuff more than ever. And I couldn't find any data to support what he said, but he just said that on CNBC last week.
Yeah.
So it's like, you know, the wages are low, they're full employment, but they're working like two jobs. Well, so it's like people are struggling, you know, they're really struggling right now.
And you've had a structural change, right? Because you've had a ton of people leave the job force, right? Since COVID, some through natural things like retirement, some saying, I don't want any more of this mess. I've got enough money. I'm retiring. I think that changes when equity prices decline. So it's more on that. I think people will re-enter the workforce if you do see a sustained downturn in equity markets. But, you know, that's the big thing. Like in Chair Powell's talked about this in a few of the pressers that, you know, the labor market looks really different. And I think there are reasons why it can hold out a lot longer structurally, because there is demand. There's a lot of my clients are talking about how they're always trying to hunt for people. They can't get workers. They can't get skilled workers in particular. So it may hang on for a little bit longer than people expect. But yeah, I mean, if that rolls over, forget it. Risk assets are going to struggle. And by the way, this is why this construction where you have passive investment, this is why the high beta stuff gets hit much harder, things like Bitcoin, because they don't have the passive flows that the major indices have. Those guys will always get that bid that comes in. The high beta, the ARKs, the Bitcoins, they're going to get crushed whenever there's real liquidity being drained from the system a lot faster than the major things, because the major indices, because they are going to have that passive bid.
I've never thought of it that way.
Yeah.
Joe, I want to throw up another chart and get Jeff and Jay your thoughts on this one. So I was interviewing Joe Consorti last week, and this was a chart he shared with me, and him and Nick Batia had constructed this. And what he was showing me was on the federal funds, which you can see here is the orange on this, compared to the 2-year. Once they went to parity is when the Fed stopped hiking. Okay. So when we look at these previous cycles, you can go back to 99. So you can see how the federal funds was underneath the 2-year. Then once the 2-year started getting bid and it came to parity with the federal funds, that's whenever they continued to just hold what they got. And then as the 2-year continued to get bid, because everyone's expecting the recession, that's when they started to ease in reverse course with their tightening. And so then we saw it again in the 2006. You can see how they held in the 2007. The 2-year starts getting bid, and then look in the 2017 through, or well, not. It's more like 2018 and the 2019. You saw the exact same thing happen again. Now look at where we're at right now in the gap, where the 2-year is at 3.2%. The federal funds is at 1.6. It's not even halfway there. I'm just throwing it up there because the gap is still massive. And here we are kind of all expecting things to get nasty, maybe in the next, quarter to 2 quarters. And like the spread there is suggesting that they're going to keep going strong into the hiking of this.
Isn't the Fed fund at 2.2 to 2.5 right now? Or
Yeah, this is a little outdated, I think.
Okay.
Oh no,
Okay.
you're right. Yeah, that's a good catch, Jay. This is outdated. I just pulled this tonight, so
I'm curious. I'm curious what that looks like. Yeah,
the data's not pulling the correct.
I'm just saying. Like, I wonder where the orange is at relative to the 2 year. Where the 2 years at? Is it narrowing?
You're still 100 bips off.
Okay, because I'm looking at the 2018 December 24th, right, and that's where it top ticked in the blue line, and then you they didn't catch each other that time. So I'm wondering if there's something to that. Maybe the bullish side of this is maybe we're getting closer to that, but I don't know.
I'll jump in here quick. Joe Consorti and I were talking about this on a couple Twitter spaces recently. And by the way, Joe is one of my favorite up and coming macro thinkers and Bitcoiners.
Totally agree. He's awesome.
If you guys don't know him or follow him, I would highly recommend it. He's a great thinker. He's just a good dude. I agree with the premise of this too. So basically what people think, they think the Fed moves the markets, but in reality, the markets move the Fed. So the 2-year treasury yield basically acts as the cap or the governor for how high the Fed can raise the federal funds rate. So right now, what it's saying, if you look at it, and I think the 2-year yield actually is up to date, even though the Fed funds rate isn't on that chart for whatever reason. It's basically saying the Fed funds can raise another 50 bips from 2.5 up to 3. They might be able to sneak it up to 3.25, at least today, right? So these things can change. But as of today, they're allowing the Fed another about 70 basis points of hikes. So either 50 or 75. I think they go 50 at the end of the September meeting, and then we'll kind of see what happens. I do like to always hedge myself with a way out because we don't know what the CPI is going to show. We're recording this before we see the July CPI numbers, and then we get the August CPI numbers still before the Fed raises rates again. So lots can happen, but basically they're putting a cap on what the Federal Reserve can do, and it holds true. So if they try to go above that, they break the bond market, and we'll start to see serious issues in the credit markets. The stock markets will collapse for sure. So it'll be very interesting to see how they proceed in the next couple of months.
Well, to your point, Jeff, the 2-year yield made a new high after the June hike, but it didn't after the July. We never took out that top tick of, I think, a 3.45. So that's interesting, right? Because you have another big 75 bip hike, and you don't take out the prior high. That's resisting, right? That's finding that bid there for the 2-year.
Preston, can you go back to that chart? I just want to see something real fast on that.
I was just throwing up Joe's chart here on the CPI with kind of the Jeff was talking about where this CPI number could potentially come in here in the coming week, and how that might impact what they do as far as raising it. We'll come back to this chart, Joe. I want you to kind of talk this because you're the one that sent this to me. Let me pull up the other one.
Yeah, I just wanted to comment on what Jeff said. Joe and I and John Ficori, we debate this all the time. This is is the market telling the Fed what to do, or is the Fed kind of pushing the market? Vice versa. The question what I'd like to see here is overlay when the Fed made comments that were hawkish prior to these moves. This is looking backwards. So I'd like to see the forward because the market buys the future. And so it'd be awesome. I mean, we're not gonna do that right now, but it would be awesome to see this and just kind of throw a little marker as to when they started to talk down what they were going to do and give guidance to what they're going to do, or other federal governors, Federal Reserve governors saying certain things in the market. Because I think that says a lot to what the market ends up doing. I don't think the market tells the Fed what to do. I think the Fed makes comments and then the market reacts before they actually make the move, because that happens later. We know that, right?
I mean, it has to be reciprocal to some extent. I agree with Jeff. I think that the market wags the tail, especially at certain periods of time where you're at. But at the same time, the Fed is having an impact as they're tightening. They're causing these things, and it's this back and forth or this dance between.
I just did a tweet storm back with John Ficori the other day, and he was saying that that's not the case. He's agreeing with you, I'm saying. And then I showed him the comments. I put screenshots of CNBC articles and stuff where the Fed made comments before they made moves on the rates, right? So the rates come later, and they come much later, months later. So you'll start to see the market move before he actually makes. So it's cute to look at a chart and say the market moved first. course they move first because they heard what the Fed was going to do. So they buy the future. That's just how you invest, right? You have to gamble on the future. So I don't know. This is a debate. This is who's your guy?
My guy. I think you're talking about Jeff Snyder.
Snyder. Yeah. No, this is all Snyderisms. It's a lot of Snyderism. I mean, he's great. He's a smart guy, but I think it's a little cute because if you kind of really want to really tell the tale, you can't look at the charts. You got to look at what the commentary was in the market that moves the market.
Yeah, that's a good point, Jay.
All right, I'm pulling that CPI one back up, Joe.
So this is a chart, and I think it's Research Affiliates that sources it, and they developed a model and incorporated into the model. So you see basically a chart of the potential path for headline CPI year over year. Now the reason why this is the focus, right, is because the Federal Reserve, particularly Chair Powell and his pressers, has said repeatedly that what they want to see is the headline number. Obviously, it's kind of interesting. Well, actually, it's interesting because their research dismisses the headline number somewhat and focuses on some of the other metrics, particularly PCE. That's their main focus. It's not CPI, but for whatever purpose, Jerome Powell has come out many times and he said that what we want to see is the headline number year over year and on a monthly basis have a sequence of declines. The problem for us with that is that if you go back and look at the inflation numbers that we had last summer, and this has been referenced by Chair Powell a couple of times, we had a dip, right, in inflation during the summer. Some of the months last year were not as hot numbers as people expected. So people said prematurely, that's it. We've sort of, slain the beast of inflation. What we have now, we're coming into the next 4 months to be dropped. You're going to have 0.5%, 0.2%, and 0.3% from the 2021 numbers. Now, if you take that and you look at the potential path forward, and this is a model, best case scenario is we stabilize at this level, but you don't necessarily see a big decline in the month over month or the year over year numbers for the next several prints. The worst case scenario is that even if we sort of trend lower on the second derivative of the growth rate, you still end up going higher for the rest of the year. So I think that the takeaway from this is that the likely base case based on this model, if it is correct and factoring in the drop months from 2021, is that you're going to get higher prints through the end of the year. Now, but the Fed has two options, right? They can either reverse course and go back on what they said just a couple months ago and said, no, just kidding. We don't really need to see back-to-back months of declines on the headline number. They can do that. That's option A. Or option B is really they say we have to stay the course. We're hiking for a lot longer. And I think that some of the most recent print and also the most recent remarks from Powell, I think that's why you saw this move between the December and the March contract for Eurodollar Futures, which is another chart we can get to at some point. But for those just looking at this chart, I think the takeaway is that you should expect inflation to most likely either stabilize or head higher for the remainder of the year on the CPI year-over-year numbers.
To your point too, Powell in the last meeting said that he will continue to make decisions meeting by meeting and carefully comb through the data. So this is the data. So he's left himself the option to pivot if he wants to.
Of course he is. Jeff.
If I can throw my nickel in here, so I completely agree with this premise. The only caveat will be if the markets tank seriously leading into this. So if the Fed does something, if something comes out as a surprise, something out of left field, and the markets collapse, that will drive down inflation significantly and cause sort of possibly a deflationary type event, similar to what we saw towards the end of 2008, 2009, or early 2009. So that's the one caveat to all of this. If that happens, then we could see everything reset much sooner. We could see inflation come under control, although it would be at the expense of markets collapsing. That would mean the S&P 500 is probably down another 20-30% or so from here, and the NASDAQ even more. So that's something that I'm considering. But yeah, otherwise we have sticky high inflation and it's going to be a tough year. I don't envy the Fed in their position right now.
Hey, I want to transition over to something that I've been toying with, and I want to run it by you guys just to hear your opinions on it. I get frustrated when I'm explaining Bitcoin to somebody and like the first thing that they do is they're just like, oh, well, it's down whatever percent in the last year. It's down. Or in a bull market, people, and I'm guilty of this, will be like, it's up this amount since the last year. And it's almost like you're just picking random points in time. And, I've always tried to say, well, to pick any 4-year period of time because of the 4-year halving cycle, pick any 4-year period of time. And what you're going to find is that you have like just tremendous performance in it. But then I started with this contraction that the central bankers are doing recently. I'm thinking, why not go back and kind of plot when they were expanding and when they were contracting based off of policy? And then let's mark each one of those points in time when it was the peak of the contraction and they reverse course, like that moment in time, to the next time that it was peak contraction, so that I can conduct a measurement from that point to this point. Almost like if you were going to measure a frequency, you'd take it from the top to the top, or you'd take it from the bottom to the bottom, but you would figure out whatever that frequency is in order to figure out how many hertz it is. And that's how you do it when you're dealing with signals. So why not try to do that with Fed policy? So I'm going to plop a chart up here for you guys. And what I did is I took the global central bank balance sheet. The Fed, it was the Fed, it was the ECB, it was the Bank of Japan, and the Chinese central bank. And I combined all of their balance sheets basically over the last 10 years, and I dropped it onto this chart. And you can see I have 2 lines, and you can kind of see the cycles as they're playing out. Now, the top line is not adjusted for the broad money supply. The bottom line is adjusted for broad money supply in the denominator. And the reason that I did that, and I converted obviously all the central banks' currencies into dollars, and then I took the dollars and then I adjusted them for broad money supply, and then one that doesn't have the adjustment, the M2 money supply. The reason I like this bottom one, this light blue line on the bottom, is because I think you can see the tightening and the expansion better. And you can see how it's really not getting worse after it's been M2 adjusted. Like this cycle here, like when you're looking at the non-M2 adjusted, it looks just enormous compared to the previous expansions, right? But then when you look at the bottom, it's pretty similar to the expansion that took place from 2017 through 2020. This most recent one that we're in. And so the black lines that I have there is just kind of earmarking these expansion and contraction. It's like basically one cycle, right? That's one frequency. And then what I wanted to do is I wanted to go back and look at Bitcoin's performance during each one of those frequencies, and then look at pretty much everything else during each one of those frequencies to see like what the relative performance is, because I feel like that is a point in time that everybody could come to an agreement on as a good place to kind of snap the chalk line, if you will. So this is the methodology. Now I'm going to show you the performance across some different baskets. So this is the first, and just so you guys know, going back to this one, I'm going to start time now in the period that we're currently in, and then I'll go back through each one of these. So here's the one we're in right now. You can see the black line right over there in the crash, the March crash of 2020. And you can see everything kind of reflate out of that. Now, just so people understand what we're comparing the performance to, obviously Bitcoin there, you got the NASDAQ, you have a bond index, you got gold, you got the Russell 3000, you got a commodities index, you got high yield debt. And then the dark red line that you guys can see there is actually just the central banks, the collective balance sheet itself, to kind of represent the amount of units kind of being added in and taken out of the system, which was 44% since the bottom of the 2020 COVID. And so when I'm looking at this, Bitcoin is still doing the best with a 284% return. And the next best was a commodities index of 101%. I'm going to just pause there. Like, what issues do you have with the methodology, or just kind of what I'm walking you through?
I love it personally. If I can jump in, I think it's great what you're doing with this, because I think exactly the same thing, Preston. I feel like I'm assuming it's going to go where we think it's going to go. That basically when we have periods of liquidity expansion, risk assets absorb that liquidity, and Bitcoin still being seen as kind of the world's, of the most volatile, highest beta risk asset, it absorbs the most liquidity in the good times. And then when that contracts, the liquidity gets taken away from Bitcoin and from other risk assets. That's when we see that downdraft. I think of it like an accordion, almost kind of expanding, shrinking, expanding, shrinking. And so you want to own these kind of assets when the central banks are expanding the monetary supply, and when they're taking it away, you want to avoid them in general.
Joe looks skeptical.
Yeah, no, I am skeptical because I think I like the idea. I think it confuses the causality versus the correlation. And the reason for that is I think it goes back to what QE actually does, which QE, it traps safe liquid collateral on the central bank's balance sheet, thereby depriving the private sector of the credit creation impulse it needs to actually drive real lending, real money printer go burr in the economy. What QE really does, and why you see this chart respond like this, is that QE tampers down volatility. And if you go, that's why I focus so much on like Bitcoin assessed in terms of the VIX or volatility in general. When you deprive the market of safe and liquid collateral, when you trap it on a central bank's balance sheet, both in the Fed and in the United States, you do provide a market of last resort for treasuries, right? It stabilizes the whole system. It pushes people further out on the risk curve. It enables fiscal policymakers to do a ton of stimulus into the system. But really what it's doing here, what you're doing is you're artificially suppressing volatility. And then you see this explosion in risk assets from the suppression of volatility. The system is trying to fix itself in these downturns and these liquidation events. And the contraction of collateral onto the central bank's balance sheet doesn't necessarily increase liquidity generally. So you have these metrics that show like global liquidity, which is a long discussion, but suffice to say, I think it's a correlation, and the causation is really the suppression of volatility. And once you start to drain liquidity from the system in the form of QT or rate hikes or any lack of fiscal stimulus, like a fiscal cliff, what you do is you reintroduce that volatility. And in a high volatility environment, stocks sell off, bonds sell off, Bitcoin sells off. It's all about the volatility and the efforts of QE to suppress volatility is what's showing you what's in front of you. That's what's the result of that chart.
Joe, what do you think? What do you think of Lynn's argument that instead of kind of getting caught up in the Jeff Snyder argument, which is QE doesn't induce money printing, which I think is partially correct. But Lynn's point is when you got the Treasury and you have the Fed acting together as a team, you're going to see broad money supply expand, right? Which is the real printing, right? And so
totally right.
What I was going back to this slide here, right? This bottom one is accounting, in my opinion, it's accounting for both of those. It's accounting for where the blue line is not, right? This blue line is just showing you the balance sheet, and it's not accounting for the broad money supply adjustment, which you are seeing in the lower chart.
So Lynn's exactly right when it comes to fiscal stimulus, right? We all agree that if the government's spending money, that is solid money printer go burr, and that's cash being injected directly into the economy. And it's spent on things like Bitcoin, it's spent on things like commodities, and it drives up the price of everything. The problem I have, or at least the question I have about how this is presented, is that if a bank, absorbs a bunch of treasuries, the central bank rather absorbs a bunch of treasuries, puts it on their balance sheet, those banks now have a ton of bank reserves, right? Yeah. But those bank reserves can't get into the real economy. They can't even get into risk assets unless, right, they decide to lend, or unless the government spends a bunch of money. And to the extent that QE enables the federal government to spend a lot of money, that's a totally legitimate point. And Lynn's exactly right. I don't dispute that. It's kind of like the enabling for the policymakers. But then what happens when the fiscal stimulus dries up? That's the story of 2022, right? Now the rubber meets the road and you see people having less cash to go around. So you're counting it twice. If a bank is just buying up treasury bonds and it's sitting on the Federal Reserve's balance sheet without any accompanying stimulus, I think, Lynn's comment to me on Twitter was like, that's just meh. So that chart you're showing is like, okay, unless there's the accompanying fiscal impulse, you're not going to get the rapid acceleration. And there's actually times you can see that on the chart. If the Congress is not spending money, you could lay it over actual fiscal outlays from the federal government. You're going to see, these periods where you're not seeing the rip. So you can see how there's the variation, right? What's the big difference with that last black bar there, Preston? The big difference is we finally realized, hey, if we give people $2 trillion in direct stimulus and PPP, and look what's going to happen, it's going to rip. So if you're explaining to Bitcoin to folks, like to me, I look at it as a necessary, inevitable conclusion that we move towards UBI. I think it's already done. It's just a question of how long before we have to move to that. And then I think Bitcoin's price is going to appreciate probably beyond all our wildest bullish dreams on this call. I think that comes, and I think it comes predominantly outside of the United States and eventually in the US.
So I agree with everything you just said. I'm just trying to, where do you choose to snap the chalk line when you're conducting a measurement of performance of Bitcoin versus every other opportunity you have in the marketplace? How do you say right here to right here is a true level of performance if I'm comparing it to the S&P 500 or the NASDAQ or you name it, anything on the planet? How do we decide where it starts and where it ends in order to say this is a true measure of the gain in the frequency?
Yeah, I mean, it's similar how they do equities, right? It's kind of arbitrary to some extent. It's year over year, sort of. Jay and I have talked about this, the kegger of Bitcoin, right? Like, or I don't think it's a necessary metric to break it down to exact specific points. You have to take the years where you get outsized growth and the years where you get, the contractions, and take it all together and say, look, on a long-term basis, this still has a ton of runway ahead of it, just relative to all these other assets, which are much more mature.
But how do you offset for the first 4 years of Bitcoin, which was growth beyond comprehension? Like, do you think that should be included in how a person
probably not
should be looking? Yeah. So I'm trying to say, okay, and I think that those early years where it was so fresh, so new, there was so few participants that it's really hard to even remotely compare that performance to what we've seen in the last, call it 5 years.
Yeah.
Because especially once we got over 100 billion in market cap, like now you're comparing something. Well, I mean, just look at this chart right here, right? Since the March 2020, that was when they stepped in and they released the floodgates, right? So what's Bitcoin's performance versus every other major index since that period of time? And what I'm seeing is that it's a 284% return. Commodities were 101%. What's our light blue? NASDAQ is 80%. And I'm saying, okay, so if you want to tell me that the cherry picker is going to step in and they're going to say, well, since October, it's down 60%. And I'm like, yeah, but I haven't been in it since October. I've been in it since back then. And in my mind, I'm crushing it relative to like all these other things.
Yeah.
And so
it's too short term though. Like 1 year here, like what we typically do is you don't look at 2009 from the start point. You look at like 2013 on, and it's still beating everything, right? So I look at it like it's a secular growth trend. I'm an early stage growth investor in technology stocks and in private companies. And I don't look at things of what they're going to do in 1 or 2 or 5 years. I look at what's the market size that they're in, what's the growth, and how are they going to gain that growth over time. Same thing with Bitcoin, right? It's the true scarce asset on the planet. It's the only true scarce asset on the planet. And everything else, including the stock market, they're creating more IPOs. There's more inventory. There's more supply. They do splits, et cetera. And they add more shares constantly. I don't see anything else there that is scarce. So you have to just say, do you believe over time there'll be increasingly more people that adopt and buy and own and hold Bitcoin? And there has been. So rather than looking at the price action, there's other things you look at to try to convince people that this growth story will continue. And you can look at the number of addresses, you can look at all those types of metrics, the hash rate, et cetera. And I don't think the price action over a 1 year period is very helpful for anybody. If they're a trader, it is. But if you want to be an investor and hold this for the long term, you can't look at price action over a 1 or 2 year period relative to every other asset. To me, that just makes, I don't ever go there with people, because you started this discussion a few minutes ago saying, how do you convince people that you're talking to about Bitcoin? I don't ever go on price action in the short term as it's relative to other assets. It doesn't make sense. So I look at like, what's the big picture? What's the long term? What's the 5 and a 10 year plan? And that's the way I speak about it.
Yeah. I guess it almost always starts off with a debate about the performance, and it always starts with what the price action was over whatever defined frame of reference they pop out, right? And you're just like, all right, so anyway, let me show you the so here's the if you buy into the the expansion and the contraction of the broad money supply based off of the balance sheets or whatever, whether you buy into that or not. I'm just going to show you a couple more periods. So this is the period we're in right now. Here's the period previous to the one we're in right now, based off of the initial chart that I showed you guys. Here's the period before that. And here's the period before that, which this one's really interesting because the broad money.
What are these? Sorry, these 1 year periods? Is that what this is? I can't.
No. It's going back to this. Can you
13.
see this chart right here?
Yep.
So each of those dark black vertical lines.
Got the periods. I got it.
I'm saying that light blue is the credit cycle, the mini.
Did you start from the 13? Do you have a 13 to present?
Yeah. So here's the 13 to.
Okay. Just so I got this right, the black bars go from the beginning of the expansion to the beginning of the tightening. Is that right?
It goes from tightening to tightening.
What I meant
bottom to bottom, basically.
Yeah, bottom to bottom. Yeah.
What I meant to say is, I guess you don't have it, but I meant 13 to 22. Do you have that chart?
No, I don't have 13. I mean, you know what that looks like. It's like not even in the same. It's like
That's
a straight
what
line on the bottom.
You have to show people that, because it's like take a number, right? Take a number to get into the asset, and you can hold. And if you're freaked out over the 1 or 2 year performance, you're not going to worry about that. And you can lay into it if it's performing well, and if not, you just hold on to it. That's the way I speak about it too.
So what I'm trying to identify, Jay, by doing it like this, I'm trying to look at, am I in the current environment outperforming, right? In this current credit cycle that we're in, which I would argue started, the bottom of it was March 2020. They stepped in, they flood the system with a bunch of printing, right? Some of it turned into printing, some of it didn't, however you want to go down that argument, right? But I think it's pretty clear that some of that printing has entered the system. So how has Bitcoin performed since March of 2020 versus everything else? And then once it becomes really obvious, and I think we're going to have an obvious event where they've reversed course, they're now flooding the system again with what Joe said, more UBI, you name it. Like they're going to have to go down this direction. That's going to be the moment in time when it's really obvious, because things are breaking, that you snap the chalk line to end the March 2020 credit cycle. Right. And then I want to look at that exact moment. I want to see how Bitcoin performed to all these other major indexes.
Sure. Yeah.
Because if it didn't outperform, well, then what did outperform? Right. Because that's the thing I really want to keep a close eye on in the next cycle. What was it? Because I can tell you right now.
It shows you here. The second in line is what? Growth stocks? It's QQQs?
So this is the cycle we're in right now.
Yeah,
right.
What's green?
And the dark green is an index GNR, which is a commodity index.
Right. Commodities. Energy.
And it did 101%, and Bitcoin's at 200.
Energy commodities. Sorry. Yeah. And then what was the last one? Was it looks like the second to that? The second to that is the Qs, right?
Bonds.
The second is Qs. What's the white?
negative 20%, which was the yellow, is TLT, which is a bond index.
Okay.
And that's been the worst.
Bonds.
Yeah. Interestingly, high yield bonds, HYG, it has had a 9%.
Isn't the
return.
blue color the second one to the right below GNR?
Yeah, that's the Nasdaq, 80%.
That's what I'm saying. That's the second best performing, other than
second
Bitcoin,
best. Yes,
Third.
I'm sorry.
Yeah, that's right. So growth is always, it's going to go to growth typically, right?
Yeah, I mean,
they're going to jump in for the next bull run.
I think it's important, if based on this methodology, if you buy into this methodology, right, it's not over yet. Like our expectation is in the coming 6 to 12 months that this thing's going to keep tightening. We're going to see more pain in the broader economy. So, if Bitcoin sells off massively, it could maybe not outperform that commodities index. I don't know. I suspect it will. But
can you flip to the previous cycles? Just go back while you're talking. I just started to interrupt you. I want to see rather what it looked like. So,
which one did you want to see, Jay?
Well, you have the current trend, and then just go back to the other cycles, just one by one.
So this was the cycle. This was the previous cycle, ending in the 2020 meltdown.
Yeah, and you can see on this chart, the Qs were number 2 to Bitcoin. Is that right? That's
correct, with the 42%.
And then you
return.
really can't tell the rest. It was, I guess, number 3 was
small
the
cap
bond
stocks.
IWD?
No, the next one down was TLT,
Yeah, it's long-term bonds.
which is your long-term bonds.
You're talking the next best performer.
Which should make sense considering I think everybody on this panel would agree that was the peak performance of the bond market, right? When 2020, March of 2020 happened, I think we could all agree that moment might have been the highest prices you're going to see in TLT.
You mean forever?
Maybe. It depends. What are these CPI numbers going to do, and how high are they going to be before they step back in? Right.
Go one cycle back if we could, Preston. Go one more back. I want to see.
And Joe,
I think the 10-year goes negative next year, so that's my call.
Joe,
so
I think you could. I think you could be right. Like I'm not saying that was the bot or the top in price terms and yield terms. Hey, I'm open to that idea that it could get bid like that.
Yeah.
I'm totally open to that idea. Now, do I think it's the most probable? I don't know. I think it's maybe a coin toss. I'm throwing this out here because I've been building these and I've been personally thinking about it. I haven't posted it on Twitter, and I'm just trying to think through a methodology that I can personally conduct analysis and be still objective in my thinking as to true performance. Part of the problem is where do you snap the chalk line to between periods to be objective with yourself? Go ahead, Joe.
So go pull up the 2017 chart, right? And we're all familiar with it. Here
you go.
Okay. So let's talk about liquidity and let's talk about tightening, right? Through Bitcoin had an incredible run, as we all know. I think somebody who came into Bitcoin in 2015, that was really the huge major bull run that I remember extensively was the 2017 bull run. And then through virtually all of 2016 and going into the top, right, the Fed was hiking, right? The Fed was hiking, tightening credit conditions. You had QT, giving, starting, I think in the Q3 or Q4 of 2017, continuing through Q18. But the question I have for you is how do you explain to somebody if you're saying that, well, it really is the central bank intervention and the central bank's monetary policy that's driving this? How do you explain to somebody that you see this rip in the Bitcoin price throughout 2017 as they're hiking and in the latter half of 2017, draining liquidity through the system in the form of QT?
But Joe, they were hiking from 2015 on. They started that in 2015.
Yeah, that's my point. Look how great Bitcoin did in the hiking cycle, guys. I'm just asking. That's
not what his chart is showing, though. Yeah, the chart is showing expansion of M2, right?
My argument there, Joe, would have, and I'm not trying to reverse engineer a counter argument. I would just say that based on the sheer size of Bitcoin back then, you're dealing with something that, is it being driven by central banks, or is it just being driven by, you got an extra 1,000 people in there buying it, and because it was so small at that point relative to now, it could just move the market price.
I still think it's that small. I think you see a few pieces on the macroeconomic chessboard move, confiscatory policies. You could see a whole host of different things from emerging markets that could make Bitcoin absolutely rip, even with QT, even with hiking interest rates. It's still a tiny market. It's smaller than single companies in the S&P 500.
Yeah,
for sure.
I wanted to pull up, and this is kind of useful because I'm showing up right now. I'm displaying the NASDAQ, and you can see a little bit of this momentum that we've been talking about from the start of 2022. You can see, and just so people know, I have some different momentum tools kind of displayed here on my chart. And just for people that are maybe not familiar with these momentum tools. So I personally like an ATR, which is an average true range. And I also like moving averages. And this is kind of both of them. And when they're both red or they're both green, for me, that's kind of an indicator that for a long-term trend, that's what I think is how I base my opinions on whether something's in a positive trend or a negative trend. So when I look at this, and whenever I really started turning bearish on the broader markets, I was looking at things like QQQ and the SPY and other indexes that help me form the opinion. I think credit's tightening. It's going to be a rough environment moving forward. And as long as neither one of these break or start turning green, I'm saying I don't think a pivot's in place. So with respect to QQQ. And here I'll zoom in on where we're at right now. And you can see, similar to like what Joe was saying, we're kind of at this crossroads where maybe it can bid a little bit more, but it's probably starting to get exhausted. I would agree with that, simply because I think you still have this really strong negative spread between CPI and treasury yields. And until that starts to get closer to parity with each other, either through a swift sell-off, like Jeff said, coming down to where the yields are at, or they keep raising the rates to get them closer to the CPI, I think that this is going to continue to be in a negative trend.
It's a good chart.
I like it. I just wanted to throw out my 2 cents a little bit regarding kind of where we are in the markets. And I think for all of us, we all know when we see the Fed raising rates, right? We're in a rate hike cycle, and we see the yield curve inverted like it is. We know that a recession is inevitable in sometime in the future, but it doesn't mean it's imminent necessarily. And so this rally that we've been seeing since mid-June, it's possible that this rally actually has legs and that this thing can go on actually for several quarters, which is kind of interesting. And so, based on this chart you're showing here, Preston, it looks like it may be coming up against a wall. It's also coming up against the 200-day moving average pretty soon as well for the NASDAQ and the S&P 500. It has reclaimed pretty solidly the 100-day moving average, which is another, strong momentum indicator that a lot of people use. So I'm personally, I'm kind of 50-50 on where it goes from here. I think that we may, while I think we're on borrowed time for risk assets, and that includes Bitcoin as well for the time being, I think that they can go higher. It's just a matter of how much and for how long, right? And so based on the stuff that I'm looking at, I think things might get ugly again kind of heading into the first half of 2023. Based on GDP kind of metrics and looking at year over year comparisons, it's looking like we could see some even more deeply negative GDP numbers at that point. So to me, it would make sense that we kind of have this sort of impressive rally that most people don't believe, heading all the way up until, say, mid-November, which happens to be right around the midterms or so. And then as the markets look ahead, usually about 6 weeks, that's kind of the metric I like to use. 1 to 2 months is kind of where you start to see regime changes before the next quarter. At that point, things could get kind of ugly again. So I'm personally, I just love the chart, but I wouldn't be surprised if this actually broke through your upper line here after a couple tries and then went higher for the time being. So I don't know if that made any sense, but I'm actually kind of bullish at the moment. It
looks like that's going to flip right there. It'll flip green, right?
Yeah.
Like
so on your moving average, and so this goes by this slingshot is if you're on TradingView and you're looking that up, that looks like that's getting ready to go. For me personally, both of them. So the ATR is that red line, and it's showing at about a 336 on the QQQ index for the NASDAQ is when that would also turn green. So I use two of them just so that they can kind of both, and normally they flip at the exact same time. So this is kind of odd that on the moving average side, it's getting ready to flip green while the other is still pretty red for the most part. What is that? It's about 7%. I would guess it's about 7% more from where it's at right now on QQQ.
Mm-hmm.
Let's talk about this margin debt chart if we can.
Oh yeah. Yeah, that was a whopper.
And I wanted to hear Jeff's take on it. I know what I think about it, but he had commented privately about how he was kind of shocked by that one. So maybe we could pull up that one.
Okay, there you go.
Okay, so for those describing, just to listening and not seeing the image here, we've got a chart of yearly change in margin debt. We're putting in numbers here in terms of the yearly change. I think it's the biggest drawdown we've had in I don't know what, more than 20 years in terms of a yearly change. So that's interesting. I don't know, Jeff, what do you think of this?
Well, yeah, I mean, obviously this adds credence to if you're feeling bullish at the moment, right? If you're at kind of all-time lows from a year-over-year change. Now, obviously, this is just a reaction to what happened a year earlier. So it was all-time highs a year earlier. Now we're kind of at all-time lows. That's generally a great sign, right? That generally means that margin is kind of being eroded away out of the market, that people aren't, levered up to their noses, to be more politically correct on what I talk about. That's a good sign. That means that people are kind of scared right now. Confidence is low. That's usually that sows the seeds for the next bull run kind of thing. Now it's interesting. You look at this chart, you would think, man, are we at the start of the next major bull market, and are we not going to have any kind of serious drawdown? I personally don't think so, right? Because of what I see, because of what the yield curve is saying, and the Fed fund, the Federal Reserve is raising rates. We're going to have a recession, basically guaranteed at some point, somewhere down the road, maybe a year and a half, maybe even 2 years. I think it comes a little sooner because I just think things move a little bit faster now, and the Fed is raising rates more quickly. So I think it comes more quickly, like probably the first half of 2023. And risk assets, the equities markets, Bitcoin, they tend to react very poorly during recessionary type conditions. So I still think we're going to have a pretty serious drawdown before that's over. But you look at this chart, and that at least for me, this makes me optimistic, at least for the next several months.
Well, the one that makes me even more optimistic, if you could pull up, Preston, is the margin debt as a percentage of the S&P market cap, which to me, this is a really bullish chart. I mean, you don't see the sort of bubbly market cap margin ratio that you saw in 2008. I mean, look how far declined we are. In fact, the margin seemed to come down and bottom around the same level as it did, prior to the pandemic there in late 2019, which is fascinating as well. So yeah, I mean, look, I mean, you're at 2000 levels of margin debt in terms of percentage. So still relatively elevated. It's not like it's down to the 90s levels or 2000 levels, but yeah, I mean, this does not show you the sort of bubble exposure to equities that you had in 2008, at least with margin debt.
What other ones you want to look at, Joe?
So the one I wanted, just in terms of the interesting movement you see is, and I look at one of the things I follow very closely is this Eurodollar Futures chart. Can you pull that one up right there?
Yep.
Let me explain what you're looking at here. So you here I have the spread between the December 2022 contract for Eurodollar Futures and the March 2023 contract. And the way to look at this is sort of there's a chart here that goes up and to the right, which is the right way you should see the Eurodollar futures contracts. They should always be advancing, right? Where as you go out into the future, they're sloping upward and to the right. They're not inverted. You don't expect, cuts down the line. You would expect that a healthy, robust economy, Eurodollar futures, which is a way to effectively bet on LIBOR, the price of money abroad in the Eurodollar system, you would expect it continually to be upward sloping, which would tell you that for the foreseeable future, the Fed is going to be either raising interest rates or pausing, right? That's not what you see here. What you saw here in this move in April, effectively, is the curve started to trend lower, trend toward a tightening, right, where you didn't expect as much hikes going out into March of 2023. And then in June, I believe it was, or late May, one of the two, you actually saw the curve invert. Now, what that practically means is that the market is anticipating in this very liquid, deep market, it's saying that by the end of the year, we think the majority of the hikes are going to be in, and there's going to be some expectation of cuts. This went all the way down. I don't know if you can see did I cut off the edge there?
Yeah. Okay. It's cut off.
So what it ended up looking at is at one point it was inverted by as many as I think 25 bips. Mm-hmm. What effectively that means is that the market was anticipating the Fed was going to either pause or potentially even cut at some point between the December meeting of this year and the March meeting in 2023. But with these recent prints and the last FOMC, we saw this huge rebound to now where, as of today, I think there's only 4 or 5 bips between it uninverts, right? That's key because that is the market participants saying, no, we think these cuts can continue. We think they can continue even into next year, into Q1, and potentially continue at the March meeting next year. So that's a sort of interesting price action, right? This is the market in real time setting expectations in this deep, sophisticated market, and market participants are saying, maybe we're wrong. Maybe we don't think we get a pause by the end of the year. Maybe inflation isn't going to come down, and we're going to have to continue with the Fed policies of tightening all the way into Q2 of next year.
And based on your CPI chart we were talking earlier, I mean, the UK just posted, I think it was last week, right? They were double digits on their inflation print, right?
Yes, absolutely.
What was the number? Was it 10 or 11% or something like that? It was way up there.
It was a monster number.
So what do you guys think this next print's going to be? because I'll be honest with you, this last one at 9, I was a little surprised. I thought it was going to be lower. I guess I'm looking at the spot commodities, like the raw commodities, and I mean they're falling through the floor. But it's all the finished parts and the complex parts that seem to be driving these prices. Just the shortage of labor. It seems like that's the thing that's just allowing these CPI prints to keep running higher and higher. So are we going to see a higher print than 9.1 on this next go around? Because if we do, I mean, that's going to be really ugly in the bond market. I mean, it's going to sell off, don't you think? Or do you think the short end? So you think it's going to get?
I think that the higher inflation stays for longer and will convince the Fed is effectively convince the market the Fed is. They can't, without losing all credibility, they cannot pivot, right? They can't pause. If they do, I mean, in many ways, that would be disastrous. I think a pivot at this point right now.
Oh, it'd be disastrous.
I think if that happens, Preston, I think you see long end yields explode north of 5%. If they pivot right now, that should, because that's what you're effectively seeing in Japan. They're taking a total.
Let's define disastrous, because people hear that and it can mean a whole lot of different things depending on which market you're talking about. So you said long duration bonds are going to sell off like crazy. I agree. Equities, they're going to go up, right? If they pivot at this point.
I think the long duration bonds will sell off if they pivot right now without tackling inflation.
Yes.
They need to get inflation down. Otherwise, inflation expectations longer out, they'll just say the Fed has no confidence. The market doesn't believe they're going to take inflation seriously.
Yeah.
I think what you see right now, even in the movements of the 10-year, you see, listen, we believe they're committed. We believe they're going to sack the economy, push us into a recession, do whatever we want to do whatever they can to stop these high CPI prints. It may take a lot longer, but that's what the long end is telling you. The long end is telling you that eventually they will be successful. The forward expectations are telling you they're going to be successful. It's just a question of when, not really if. But if they pivot, oh man, I mean that changes the entire ball game. So if you're a fixed income investor, you're not begging for a pivot right now.
Yeah. And so we don't think, I think collectively as a group, we don't think they're going to pivot. We think that they're going to continue to be pretty aggressive in their stance, right? Yeah, everyone's nodding their heads. So let's say the CPI does come in hot, similar to what we saw in the UK. Do we just see the bond yield curve continue to invert between the long end and the short end? It just keeps getting more and more negative, like the 10 to 2 year that we were talking about earlier, close to, what was it, negative 40.45%.
Mm-hmm. Could follow Canada down most inverted in history. You could, which makes sense, right? With the highest inflation expectations last 50 years, you're probably going to have the most inverted curve in history for the United States Treasury.
And I'll throw it in there. It'll stay inverted, but it'll all rise higher though too, right? So we're going to see the 2-year yields go higher, and the 10-year yields they're still going to be inverted and severely inverted. But if we see inflation continue to come in hot, that's basically the short end of the yield curve, the 2 years. What I like to look at, they're going to keep going up to give the Fed permission to keep raising rates more. They're like, oh shoot, this is sticky high inflation. You have to keep raising rates. You have to keep being more aggressive. So right now it's sitting at 3.2% for the 2-year. Right, 3.21% right now, the 2-year yield. If it comes in hot, I think it goes boom, and it's going to go up to like 3.6%. And the 10 years are going to go from, what are they, 2.75 right now? That'll go boom, and it'll go up to like 3% or something like that. But it's still going to be distorted, and it's still saying a recession is coming. It's just saying the Fed needs to keep tightening for longer. Does that make sense? That's how I read it.
Yeah. While we were talking there, because I said I was going to try to build the Canadian yield curve here while we were talking. So I did build it. Let me share it. Okay, so I don't have it. I'm assuming you're referencing the difference between the 10-year and the 2-year, Joe. Okay, so we can see here the 10-year, which is the lowest yield in Canada right now, 2.6%. The 2-year is at 3.2% for...
It's like 46.
Yeah, it's similar to the U.S.'s spread, but evidently they haven't had
56. 56 bips.
So it is.
Yeah, that's it.
The U.S. Okay.
56 bips.
Dang.
That's a massive spread, right? Like that's.
Yeah. Wow. Look at that. Look at that. 1, 2, 3, 4. It's completely inverted. Fascinating stuff. Let's put some of the charts away here. What are your thoughts on what's happening in China with the real estate market? Any thoughts on that one?
I just think, was it unexpected, right? I mean, we all saw this coming from, it's sort of like we all saw what happened with COVID and the whole shutdown and then flooding people's accounts with free money. We all knew what was coming after this. I feel like with China, they went through this decade of just massive real estate building. Ghost towns, we all saw pictures of it, so at some point this comes home to roost. At some point you have to pay the bills, and they're seeing it right now. So everything's great when the markets are going up and the equities are going up and to the right, and liquidity is flowing freely and banks are lending, all that kind of stuff. And to Joe's point, when volatility is low, but when all of that shifts and you transition to contraction times and higher volatility and banks aren't lending anymore, things get ugly. And that's when you see who's swimming naked, right? The tide just went out for the China real estate market. So that's how I look at it. I think it's inevitable. It's going to get worse before it gets better as well.
I continually find China so hard to study and analyze just because their data is so questionable. I mean, it's a black box. It's really difficult. And you never know what's manipulation, what's modified numbers, whether it's, whether they're trying to project an image to the world for some purpose or some economic reason, as opposed to, or geopolitical reason, as opposed to actually, here's what's really going on in the economy.
How about here in the U.S., real estate wise?
Well, I mean, obviously it's pulled back a little bit. I mean, there's a ton of metrics that show, price cuts across the board. And that's not unexpected. The question for me though is where's the systemic risk, right? What transforms this from a garden variety correction or a mid-cycle correction that some of the CNBC people keep pounding the desk on, to something systemic? And I've heard arguments, I've heard conjecture. I don't know. Maybe Jeff, you got some data that really makes you bearish on real estate. I don't know. I don't see it.
I'm not too worried about real estate. I mean, I think it's clearly turned over already. It's over the hump and prices are declining. I definitely don't think we're having another great financial crisis redo. We're not going to have massive crashes, and there's not going to be a subprime mortgage crisis. Banks aren't going to collapse, all that kind of stuff. So I'm not really worried about real estate. To me, more of the concern that I watch is the sovereigns. I wonder about emerging market debt. What's going to happen if the dollar continues to strengthen and these, developing nations continue deeper and deeper into a recession and they just can't pay back their debt and then they start to default? What happens then? Do we get contagion at that point? That's what I'm kind of watching for.
Can we talk about that for a second? Has the dollar put in a shorter intermediate term peak?
Has it?
Yeah.
In the short term?
And before you answer, I just put up my momentum chart on.
The trend
What's the
is
momentum chart say? Yeah.
It's still going up, right?
Oh, yeah. It's very green.
You got to pull up your momentum chart too on gasoline. We got to talk about that in a little bit. But
I can pull that up. I'll build it. Hold on.
I mean, if the dollar gets up to 115, 120, which it certainly could, right? It's going to just destroy some of these developed nations. I think we're going to see. I think the action is in the credit market. Not to mention, by the way, high yield debt. So there's a lot of zombie companies out there that have been kind of floating along since 2009, 2010 that shouldn't have continued floating along. At some point, they have to pay the piper as well. I know we've talked about this. We went back and forth a little bit, Joe, but I think some of those companies are not going to make it if they have to try to roll over debt when we get deeper into this recession. That's what I get concerned about. That's, to me, is what we could flip from just a mild recession to a very serious recession. Is I'm looking at high yield, and more importantly, I'm looking at sovereign debt.
Well, Joe, what are your thoughts on the dollar, the chart that we've got up right now? You think it still has room to run? I think
the stuff I look at says that we've put in the peak for the year. Next year,
really?
So much. Yeah, no, I have some my own indicators and things I look at. I think we've peaked.
What do you think's driving that?
That does not mean we roll over, right? Does not mean we go. But the same. Let me put it this way. When we were texting back and forth and I was telling you gasoline and oil had peaked, the exact same triggers are hitting right now on the dollar. So again, like, this does not mean roll over. It doesn't mean that in the near term, dollars going back to 50 or 60 or 70. That's not, they could roll back down to, 99, 95, sitting there and consolidate for a while. But for the short term, I think the dollar's peaked.
That's interesting.
I don't actually disagree with that, by the way. If we do get this rally, this sort of risk on rally for a while, that would suggest that the dollar is going to weaken. That's usually kind of because they tend to go hand in hand. The dollar weakens, risk assets tend to spike. But then when we head into the next recession and things get serious, then the dollar rips higher again.
Yep.
Even in the face of everything that's happening over in Europe, because like when I'm looking at like what's driving the DXY, so much of it is Japan and Europe. And I just, like when I'm looking at those two, I'm saying they're going to be way worse than the US in the next 6 months. So like the dollar
way
keeps
worse
bidding.
how? Way worse in the terms of their economy?
Yeah. Mm-hmm. Based on everything that's happening, especially with the Ukraine situation. So that's the reason why I think the dollar keeps moving from here. But
yeah, I mean, you talked with Macro Alfonso Picatiello about this, but I think that the move lower already we've seen in the dollar, which is marginal at best right now, but I think it's being driven by this anti-fragmentation tool. So you have that liquidity papering over some of the weakest parts of Europe, right? That's coming in now. We've seen the ECB attempt to sort of have this, have their cake and eat it too now with being able to paper over some of the weaker parts of the country, or the EU parts of Europe. So I think that's going to be, that's driving some of this movement. You've seen it's easing some of the pressure on the most vulnerable countries.
Yeah, I don't know. That's going to be an interesting one to see. I'm not sure that I completely agree with you on that one, Joe. Okay, I'm sharing the oil.
There you go.
The oil chart here. And you are right. In a text message, you nailed the living heck out of this stuff. And I said, well, I'm still on a momentum. I'm still thinking it's kind of green, but then this just triggered this past week that it turned red.
So explain that. What just triggered? What does that mean?
This is just that average true range, which is based off of the volatility of this particular of the oil chart. And so it was hanging in there. I wasn't willing to say that I think it's reversed, but I think it was Thursday last week or Friday last week that this finally went red. But yeah, you called it, man, in the text, and I was like, I don't know, we'll see. And maybe who knows? I mean, this is one metric. It could still turn aggressively upward, but I'm with you. I think that you're in a negative trend there for oil now. And here's the I don't have any momentum indicators here on this, but yeah, so natural gas, diesel fuel, and gasoline being displayed from basically the start of the year. And you can see all of them are off of their highs and kind of going sideways or down across the board. What are your thoughts on this, Joe?
Well, I mean, this just shows you go back and look at the last several recessions, right? You see the commodity prices peak first, then you see CPI peak, and then several months thereafter, we're ended up in a recession. That's the same sequence, right? It coincides with the growth expectation of the market. These things are rolling over first, and they roll over before CPI, which, to the point we were talking about earlier, that can tell you that, CPI could go for a little bit longer, even though the commodities are sort of your first warning sign that growth expectations are deteriorating moving into the next year. When inflation does peak and start to roll over, that's when you can expect us to be very close to a recession. I know people say we're in a recession now, but there's other metrics that NBER looks at to use their definition.
Can I jump in here based on that last oil chart you showed? Just because I've tweeted this out a couple of times. This, to Joe's point, this recession is kind of following the textbook playbook of what recessions are supposed to do, based on what he was talking about, commodities. When oil was up in the 120s and 115-ish range, I was saying what I'm watching for next is for oil to break. When oil breaks, that'll be the sign that we've kind of started the next phase of the recession. And then I show pictures of what the recession looked like from 2007 through kind of 2009. Phase one of that recession was oil was ripping higher, commodities were going higher, people were concerned about inflation, and stocks, and I like to look at the NASDAQ, so the Qs were declining substantially. They got hit hard. Then what happened, phase two, was when oil peaked and then finally started coming down. That's basically from early 2018 through kind of late 2018. There's like a 6-month swath right there where oil was breaking and stocks were rallying. They went up, kind of found another kind of a local high and then another lower high. That was phase two. That's what I think we're in right now. We're like, okay, I think inflation's actually going to be under control. Oil broke. The markets aren't as concerned about inflation currently. We're seeing equities rally, risk assets are rallying. That lasts for about 6 months or so. At least that's what it did back then. And then phase 3 is when the floor drops out. Basically, oil, the people are like, oh, like we're actually headed into a serious recession. Oil drops out, equities dropped out, and then it just got like freaky ugly at that point. And that's when the credit market seized up. All that other stuff happened. So I think it's going to happen kind of the same this time too. I'm following the same sort of playbook, and that's what makes me think. We had that June 15th or mid-June low in risk assets. They started to rally. Oil's been falling. I think they could rally all the way up through maybe November, maybe December. Who knows? And then we get to that moment because we're headed into a serious recession, and then the floor drops out of everything. That's the playbook I'm following right now, and so far so good. I don't know if you guys have any thoughts on that.
No, I think that's spot on. The one thing I'll add, and I think it speaks to 2 points we've talked about so far, and I want to talk about with Jay, get his thoughts on these in particular. So I sent over, Preston, I don't know if you see these 2 charts back to back. Maybe we can quickly show them. One of them, they both start with the title infographic, and this comes from JP Morgan Chase data that's publicly available. Pull up either one of them. It doesn't matter which one. We can go through each one. Okay. So this is really kind of a mind-bending chart when you dig into it. So what you're seeing here is you're seeing the percent change relative to 2019 pre-pandemic in median weekly checking account balances by income quartile. So what this effectively doing, each one of these lines, you're showing the different quartiles of income, and you're trying to see how much is this different from 2019 pre-pandemic, right? When we had all the stimulus money flow into people's accounts. And the interesting thing about it for me is that across all income, this is, checking account data in real time from JP Morgan, across all income quartiles, you see elevated weekly checking account balances. You're doing it on a weekly basis, on a rolling basis, to see how much money do people actually have in their account to meet these, higher CPI pressures. And you see consistently they remain elevated. That message tells you that this is going to push CPI up for a longer time period, and it's going to potentially be sort of a delay, right? And to drain some of this liquidity, drain down these balances to where they have to come back to the 2019 level before you have that hard down that I think many at least are expecting in the equity market, in the real economy, in consumption generally. So this is a fascinating one. And then the second one, if you could pull that up quickly, this one is the actual median weekly checking account balances by age group. Same story here. Given the stimulus checks, the child tax credit, a ton of cash is just sitting on people's checking account balances, still has not found its way into the economy. Every age group, every demographic, 18 to 34, the seniors, they're still sitting on that cash. They have not plowed it all into the stock market. It is not eroded. This data, I think, is the end of Q1 data, but they've posted similar charts even as late as Q2 at the end of June, still elevated.
Do we think because of their working capital accounts that's the reason for this? And Jay, what was your question?
I was just going to say, Joe, in the last meeting, I thought you had some data or some survey or something that said that people were plowing the money into the markets.
Oh yeah, no, I mean, portions of the money found its way into the market, right? I don't think there's any. But saying,
by and large, it's been sitting in the bank. You can see the numbers are going.
Well, just look at the balances, right? Look at now. Where does that come from? Okay, some of it's stimulus, some of it's the child tax credits that came through all last year. But if you're going through your daily life and you're just a regular middle income guy, and you are comparing what's in your checking account right now to what it was in 2019, it's elevated. Right. Now you may not feel that because of inflation, but I don't know. What's your thought?
I was just going to say, I think the Fed is probably keenly aware of this. And I think that for them to create the demand destruction, they're going to keep raising those rates so that they can get unemployment up. I think they're headed towards trying to increase the unemployment, right? So make people afraid at the bottom end of employment that they may lose their jobs, and actually have people lose their jobs. And that will hopefully curb inflation, because that's their game plan, right? So they're going to keep getting aggressive.
So if Jeff's right, and you and I happen to be sympathetic to the same thing, if equity prices then go up higher, right? And are they going to be successful?
They won't go higher when they start laying people off.
Correct. But we're talking.
So they're going to keep. My point is, they're going to keep pushing on the gas pedal, the Fed, until that happens, right? They're going to keep raising those rates aggressively. I think they're going to get more aggressive. So you asked earlier, what are they going to do? I think it's 75 bips this time coming up. possibly 100.
I mean, think about how rough it's going to be for Jerome Powell's life if you get the S&P back to 4,600. You know,
he's got to get aggressive. He's got to be aggressive if he's trying to accomplish his goal. I personally don't think that that's going to change it because I think you have supply chain issues, and I really don't think this plan is going to work. But we'll see. But they're going to keep at it. I mean, he literally said they're going to keep at it. I forget the exact words he used, but he said something along those lines.
What's your take on this, Preston? What do you think about this JP Morgan data?
I think Jay's point is valid in that maybe people are preparing a little bit for the storm coming, but then also I'm just thinking about if everybody's costs are going up. If you're a business and all your costs are going up, you got whatever your variable costs are more dynamic. You have to have a larger working capital cash account for that business in order to facilitate that variance that you're now seeing. And so that's the only thing I can kind of hang my hat on when I'm looking at it.
Here's what he said at the press conference. I actually took some notes on this. He commented, voiced concerns with high and rising inflation. It was all about inflation in the press conference, as you may recall. Determined to bring it down, and they will tolerate a recession if that's what's needed to get the job done. Very hawkish, right? And then he also said another unusually large increase could be appropriate. I think they're going to get aggressive. And I think they're pushing.
I mean, it all comes down to the CPI print. If it comes in like the UK's and it's at 10%,
I don't think it does come down to the CPI print. I mean, unless it drops dramatically.
Really?
No, I think it's about employment. I really think it's about employment. I mean, the CPI is part. It's tied to it, right?
It's both. Yeah, it's both.
Yeah. So, but if it comes down slightly, I don't think that matters. If it drops dramatically, I don't see that happening.
To Jay's point, right? He has specifically mentioned how he's fearful of a wage price spiral. He's talked about imbalance in the labor market. He says it's not a healthy thing to have 2 job openings for every employee, and that it gives so much. I mean, it's kind of amazing, right? From a political standpoint, it gives so much bargaining power to workers to say, "No, screw you, I want more money," right? And that's how you get really sustained high inflation.
Yeah, he wants to see weakening in the job market. That's the goal, I think, at this point. And when there's too many open roles, wages rise quickly, which can make the economy, the inflation could get way, way worse then, I think. So I think that's what his goal is at this point. That's what he's focused on.
Boy, oh boy. The only thing we need now is for Dr. Jeff to talk about COVID. What's your opinions on COVID, Jeff?
Or monkeypox. Tell us about monkeypox. It's now a national emergency.
It's a national emergency, so be careful out there, everybody.
Well, that's just more,
Stop talking. Stop talking.
It was a joke.
It was a joke.
No, for real. No. It's actually not a joke, guys, because there are so many. We're talking about charts and all this data, but the reality is this is a narrative game, right?
Oh,
that's what I think is that's what I think is happening. And you're setting up towards there's so many potential risks that can take all these charts and just throw right out the window, right? You have lockdowns in China. We have problems with inflation again, with supply chain issues.
That's when I'm looking at this current run that we've seen, like this aggressive bid that we've had. I'm just worried like any little bit of bad news is going to just immediately plug the recession into people's heads. And they're like, there's no way this thing's going higher. What in the world are we thinking? And then
it's all like a raid of Mar-a-Lago. Is that gonna drive?
Yeah. There you go.
It's all about uncertainty. We're living in times of uncertainty right now, which means you don't know which way it's going to go. Right. So that's where the market's at. And there's so many different contributing factors that could just change in a heartbeat. Right. Look at Friday. Thursday was there a 34% chance of a 75 bit was the survey, right, in the market. And now it's a 66% in one day. Right.
Yeah.
So that's where we're living.
How do you guys want to leave this? Do you guys want to
positive?
make your call for the next quarter? Or you just want to leave it at this, and then we don't have to worry about whether you were right or wrong?
No, let's do a call. Yeah.
I'll just throw out what I'm doing in for my client accounts and stuff is I'm getting increasingly long because I think this rally has legs. I think it's going to probably hold. Now, everybody keep in mind we're recording this before we know the CPI numbers for July. So the things can change quickly. But as of today, I'm getting increasingly long, but I have tight trailing stops because at some point the bottom's going to drop out. That could be in a week, or that could be in a month, or it could be like 3 or 4 months from now. We just don't know. And so I just say be very careful because there's still extensive risk to the downside for most assets, risk assets especially. So I think what we're going to see. I love the chart earlier. We were talking about the leverage in the system. There's very low leverage in the system right now, which is fantastic. If you see those numbers starting to rise again and people starting to get giddy and like, hey, we got through this. The Fed did it. Yay, Powell. Jeff, Dr. Bear was wrong. We're going on to bigger and better things. That's when you should get scared. That's when we're probably getting set up for the floor to drop out. So just be careful out there. Use trailing stops or just dollar cost average through it. For Bitcoin, by the way, I'll throw in my Bitcoin thoughts and then I'll stop talking. It's possible that 17.6 was the low for Bitcoin, and it's possible that we get just sort of a slow grind higher from here. I think it's undervalued right now. I think it's very cheap. I think that the whole Terra Luna debacle and Celsius and Voyager, all that garbage, really pulled it down. That was a hard capitulatory type event for Bitcoin, and so I think most of the badness got wrung out of it at that point. If we do go into a deep recession again, I think that's probably coming next year, maybe early 2023. It could tank again, and it probably will tank again. So just be careful for that as well. But we could have a pretty nice rally into the end of this year. I've been saying since the beginning of the year, my price target at the end of 2022 was 50,001 penny, and I'm still standing with that. I think it could happen.
Joe?
Oh, so full disclosure, I am massively long through options here, the long bond into 2024. I expect to get to 0 or negative rates on the 10-year at some point next year. I'm not going to try and time it. I've been accumulating for the last month or so, just a huge position, and it's moved in my favor, which I'm very happy about. And I expect long end yields to decline from here and 10-year to find a bid. I think bonds will be the trade of second half rather than play the vanity trade of the equity market. I'm just going to do my thing because I think Jeff could absolutely be right. And in fact, it's probably if you had to ask me, gun to my head, my base case expectation, I think equities go higher from here. I think at a minimum, we're visiting the 4,500 on the S&P. I think NASDAQ goes higher. I think Bitcoin goes higher. But again, it's in some ways a sucker's rally, right? Because everything is deteriorating. And if you're going to try and time that, good luck. I don't want to mess with that. I'd rather do what I'm comfortable with, which is I think that the flight to safety trade will be alive next year as the real economy deteriorates. So just in terms of disclosure, that's where I'm at in terms of positioning. Obviously, I don't trade Bitcoin. I never trade Bitcoin. I think it's stupid to do that. I accumulate when it's cheap. I bought dips below 20K this time. I'm going to continue to buy probably up and down again. I'll buy higher levels from now and I'll buy lower levels from now. Hopefully we get cheaper prices, but I suspect that Jeff's probably going to be right, at least for the near term. I think Bitcoin is going to, it's got to at least go higher for a little bit here. In terms of, what I'm looking at in the Bitcoin broader market, I'm very eagerly waiting these reports we're going to get from the executive order. Keep in mind, we had that executive order that came down that commissioned various studies and reports to come and be fed to the president to foster legislation in Congress. Those are going to come in the early part of September. So that's going to be a lot of headlines, a lot of news and reaction about, here's what the president's commission found. Here's what Treasury found. Here's what various different Department of Energy found. It could be bad. It could be FUD. Just be aware it's coming in the first part of September there. And also, you can expect, I think, some election sort of dynamics coming into play. I think the student loan thing is going to happen, right? And also, one thing I think I texted you about this, Preston. I think it's going to be fascinating to see if we get a boon to equities from this. You had that. The quote unquote Inflation Reduction Act that got passed, which they had that excise tax on capital gains, right? But it doesn't come into effect until January 1st, 2023. So are there companies out there that are thinking, hey, maybe if we front load some of our buybacks and do it this quarter and into Q4, because we don't want to pay the excess tax on buybacks that starts January 1st, 2023. We want to do it now, front load it. I think that could be another boon to equities. So could, again, contribute to the risk on rally. So I don't want to be bearish here. I want to be bullish bonds, but I think it could roll over, right? Nobody knows.
So I threw up the 30-year here, Joe.
Yeah.
And you can see we got down, we're basically at 1% there for a little bit in 2020. So you're thinking in the coming year to year and a half, we're gonna go lower than 1% on the 30-year?
Absolutely. Yeah.
All right. There you go. You heard it here first, folks. All right. And just so people know, that line on the top of this chart is the 40-year trend line that it had never punched through. You can see it tipped through there a little bit. These are weekly bars that we're looking at. It punched through it there a little bit on this last bidding, or this last sell-off. And now it's starting to bid. So we'll see if Joe's trade there continues to work out.
And you see that, go back for 1 second real quick, Preston.
Yeah.
I'm sorry.
Yeah.
You just got to look at this structurally. Okay. Look what happened. Okay. I want to talk about QE, right? QE buying massive amounts of bonds, right? Look at the wick. Okay. What does that wick tell you right there? That wick is total dysfunction and lack of liquidity in the treasury market. And what happens when they're buying tons of bonds, right? When they're buying tons of bonds and they stabilize it and yields go higher. Okay, yeah. Explain to me, you're an astute, bond market observer. Explain to me how QE right there in terms of quote unquote buying bonds is driving the yields higher there.
Well, I don't see the QE actions as happening in sequence, right? Like it's out of phase. The implications are out of phase from what you're seeing in yields.
What do you mean by that?
So like when you have an out of phase action, if I'm pushing a swing, right, and I'm pushing, then the swing is in phase with my pushes. But in some types of frequencies, when you're pushing or you're trying to move it with a vector to the left, it actually is moving the exact opposite. But that doesn't mean that they're not correlated.
Well, yields bottom right when QE begins.
Yeah,
that's what we know from this chart. I mean, that's that wick. Yeah. The yields bottom right when QE begins.
Yeah. Yeah. So, I mean, you got to realize their actions over a long period of time, right? Their actions stepping in and clawing these instruments out of the market on a net basis on a long time horizon. Like, I don't care what anybody says. If you're removing securities out of the market, you're playing with the pricing mechanism of what they are. Right. Like if you go to a market and I'm pulling oranges out of the inventory that's there, it doesn't necessarily have an immediate impact. But if you keep doing that on a long enough net basis, like it's going to impact the price. Right. The reason they're making that action to assume that it has no implication. And this is the question I posed to Jeff Snyder is, well, then why are they doing anything? If it does nothing, then why do they keep doing it over and over again?
Yeah, the answer is to change the market psychology, to make them think that everything's backstopping with liquidity.
Give me a break. Give me a break. I'm with Lynn. So like when you look at the M2, that's what's being realized in the market. But as they continue to adjust, because what they're playing with is the duration, right? As you're constantly stepping into the market and doing these activities, what you're doing is you're messing with the duration because they're swapping something out that's yielding 5% for 30 years, and you're swapping it out for something that yields 4% at 30 years. And as you keep doing that, you're driving the duration down to nothing at nothing percent. Right. So to suggest that it's psychology, I don't buy that for a second. It's mathematics. And it's mathematics over a long period of time. That's not an in phase where you see the implications while it's being input. It's an out of phase implications of the input. But you know what? I value the difference in opinion. I just think that as you do this over a long enough period of time, you're truly messing with the duration. You're messing with the discount rates. You're messing with the cost of capital. And there's a reason that we all think UBI is going to happen. It's because you've completely jacked the pricing mechanism of reality, of the price of everything. Right? That's why UBI has to happen. Next.
Yeah.
That's why
continued.
That's why yield curve control has to happen.
Right.
You know? So, Jay.
Well, with that said, You just said it all. I think like I said earlier, it comes down to the Fed's going to be looking at inflation and employment data, mostly employment data, but they're tied together, obviously. So I think that's what you got to keep looking at. Inflation is rising; it continues to rise every month. I would just look at that. Oil prices, like we did. Look at the earnings calls. Look what these companies are saying. Look what happened today with Nvidia. Like, just keep listening to what's happening in the market as it relates to their guidance, and that'll kind of give you some guidance as to where you think things are going. Facebook just reported their first revenue decline as a public company recently, ever. So
they are the absolute worst. I'm sorry. I don't like to usually. I cannot stand that company.
But you're going to see more. You're going to see more of this stuff, right? And so as you see that, the markets are just deteriorating, right? So I don't see anything positive here. I hear you. There's potentially a bull run that's happening right now. We have to get past 4,200 and 4,500, and we'll see what happens. I don't.
Is it a bull run or is it a bounce?
Well, it's a bull trap. Is really what? Or a bear trap rather. Right? It's a bear trap.
And you guys all agree with that, right?
Yeah.
I don't think necessarily. Yeah. Sorry, Jeff.
It's all semantics,
right? So it seems like there's more things to the downside. I don't see what can surprise us to the upside. I'm missing that. I don't know what that is. That makes us go into a bull market and we just take off from here for the next.
What about CPI declining rapidly?
Why would that happen?
Oh, so you think CPI is going to remain persistently high through next year?
Oh, the next year.
Well, if that's true, we're not going into a recession. Right.
You're putting words in my mouth. I didn't say all of next year. Okay. You're talking about to the end of this year for the next few months, right?
Yeah. And just
markets don't go straight up or down, right? So I don't think we're going to see from this point. Like, first of all, I'm not so sure that June, what was it, 14th or so was the bottom. Could be.
Yeah.
I'm not so sure about that. Right. And so we have this run happening right now. And the data points that I was just commenting on, which is inflation and obviously employment, the employment data that we see from ADP numbers that come out, as well as the economic data that we get released. That's what's driving everything, I think, and that's what's going to drive. And obviously, that's driving the Fed. The Fed's going to drive the interest rates. The interest rates go up, and the Fed fund rates. Then companies are going to start getting cautious about their cost of capital, and they're going to start laying people off. And that's what the Fed's pushing for, I think. And so that hasn't happened yet. And when that starts to happen, that's when the markets will roll. And that'll be the bottom.
I'll throw in again my two sats here is that I think the markets have officially don't really care about inflation as much anymore. I think the inflation part of the descent of equities and risk assets has already taken place. And I think the rally continues until people finally get concerned about the recession being serious.
Like that.
That's how I'm viewing that. I think it's a psychology game right now.
Why would you get concerned about the recession?
Because they're going to see that things are actually really seriously bad, and we're going to be in a worldwide recession, and it's going to be inarguable by winter or late fall. People are going to start to look ahead and be like it's really ugly out there.
Yeah. I'm asking you what the cause of that recession will be.
It's slowing, so negative GDP, and to your point,
and what is that? That's what I'm asking. Like, I'm getting to the root of it. What is causing the GDP to contract?
So unemployment is very low. So people are going to start getting fired. Companies are going to quit hiring. People are going to be out on their
rising rates. Federal Reserve rising the rates, lay people off. Then they have to pivot because there's too many people getting let off too fast, and that's when it reverses the other way. We're not near that yet.
I'm just trying to put a time frame on everything. So that's kind of how I see this all playing out. Is a few more months of a rally because people think we're kind of over it. The inflation was a big deal, not that big of a deal anymore. We're getting through this. Could just be a mid-cycle, a little dip. We're pulling out of it, and then people are like, again, sorry for the foul language. We're actually heading into a more serious recession.
I think I did good on this episode without blank.
You guys all did really good, really good.
No, but I think for this year, I don't know that I don't know how far we go up, but we can continue to rise, to your point. But there's so many negative and narrative things that I was talking about that could make it just pull back down again and just test that bottom or get closer. Yep. So I'm not so sure that we're ripping up all the way to the top here and testing the all-time highs or anything like that. So I don't know. I'm still worried. I'm pretty worried about
you're negative. You're negative on all-time. Everybody want to use negative on all-time highs this year? On SPY, for example, on the S&P 500.
S&P, I don't think that's happening. I think there's too many. Listen, could it happen, Joe? Absolutely, but there's too many economic data points that people are looking at and other factors that are every week. I will say this: the market is pushing up any chance it can. Any chance it can go up, it goes up. But any chance they can go down, which keeps happening every few weeks, it just drops again. And so that's the thing that we're faced with, is that there's too many potential things that could push the market down. But it does want to push. To your point, Joe, the market is very optimistic and it wants to rally, and it's trying to, but there's too many things that keep getting thrown at it.
Yeah. I'm of the opinion that this is getting exhausted, this current bounce that we're in. I don't think it has too much more to go. We're at that level now, 4,200. Yeah, right? I think it could run for another couple weeks at most, and then it's going to maybe start rolling over is my base case. But similar to Jay, like, hey, I'm not an absolutist on anything. Like, I'm all looking in probabilities, right? I'm saying, hey, could it go further? Of course, but the bigger momentum trend for me is that you're seeing a bounce and it's fizzling. It's about to fizzle out. So
Joe, do you think
my expectation in the fourth quarter will be lower?
Yeah. Well, so let me give you the probabilities in my mind. I think we break through 42. I think that the real water line for me is this 4,300 area. I tell you this, put it this way: if we get above 4,400, we're going to new all-time highs.
So check this out.
That's the line in the sand.
Let me say this to you. Like, so today I'm watching the market the last few days, right? So today you see the market, it's pushing, right? The Nvidia thing comes out and the market dips. It's like, it's one freaking company that's clearly tied to Bitcoin mining. Like, come on, everybody knows that. And yet the market starts to pull back off of that. It's looking for a reason to pull back. It's also looking for a reason to go up. It's trying to sit in a channel right now. If it breaks like above 4,200, all bets are off. It could really start to rally. And this is a resistance level that it's got to get through, I think. And
you're exactly. We're on the same page. I just the chart, the difference in this current rally, bear market, because we had that bear trap in March, right? We didn't get to these charts, but I'll just briefly summarize them. Look at the VIX. Look where the VIX is breaking a level. We had this higher low through basically through October of last year. We've always put in these higher lows. Look at high yield. Look at credit spreads. They're telling you the risk on trade is here. And even look at, we didn't get to the XLA versus SPY, but like, this is what you see. You see the return to the leadership. You see technology is back outperforming, and QQQs are outperforming SPY. This could be a bear trap, right? But once you start to break really good levels, the market's going to get completely bullish again. They're going to think the Fed's got everything in control, and you can't discount the potential with a passive flow for us to just go to new all-time highs.
But
and it could really mess people up. It could be like the Bitcoin chart, guys, right? Like, you get back up to 4,800, 4,900, and people think, okay, the coast is clear, and that's the second double top, and it rolls over.
If it's not something that's an exogenous event, like China lockdown or something like that, they will send their other Fed officials out to make comments, right? Whether it's the one out of San Francisco or Cleveland or whatever, they're constantly, they also leak this stuff out to try to pull the market, I think, to pull the markets back, right? Sure. That's what I think they're trying to do. So as it starts to rally, I think they're going to try to do whatever they can if it's not some other exogenous event that they can't control. But most of the things are just going to be things they don't have to do.
That's what I said earlier. Like, it's going to be Jerome Powell's worst nightmare if he still has CPI really high. And at the same time, you've got this issue of, higher SPY, you've got higher asset prices. They're like, whoa, how high do we have to hike rates to tank the market? That's what he's going to be thinking. Was it
Mester? I have something here. She said, she told the Washington Post, like, how they do this, right? So she says that it would be inappropriate to cry victory too early, I guess, to your point here, and to and risk letting high inflation become entrenched. We need to see really compelling evidence that inflation is moving down. And in my view, they haven't seen that yet. So listen, she's just putting that word out there to try to pull the market back a little bit. Like, wait a second, the Fed's not so happy about where things are at. So when the market starts to rally, they're just going to come out with their comments.
Yep.
Put pressure on it.
Joe, real fast.
Good luck.
I put up the VIX.
You might be right.
I put up the VIX and also the move. And, it seems like the move is the bigger, the index for the credit markets, for the volatility in the credit markets. Seems like that's the bigger story than necessarily the equity volatility.
Absolutely.
Which would make sense based off of this current setup with inflation and all the treasuries being at the yields they're at. I'm sorry to interrupt you. Go ahead.
No, you got it. I mean, this move in the bond market was historic in the first half of this year. Bonds absolutely got smoked. is a 4 standard deviation move. There have been few times in history, absent a credit crisis, where you've had this kind of turmoil in the bond market. And, the high elevated move, the takeaway from that is that you're on the fastest rate hiking cycle in history. We've never moved this quickly. I mean, the fact that we're talking about 75 and 100 basis point hikes, I think, is something that speaks to the volatility and uncertainty in the market. And that's why you'd expect an elevated move. Right, because it's responding to, is Nick Timiraos of the Wall Street Journal going to leak next week that we're hiking 150 basis points and surprise everybody? That's kind of how they're doing policy now, and I think it's and good luck bond traders in the short run because the volatility is through the roof.
But on top of that, we then have a print of 528,000 jobs. So that's a surprise. Did you guess that would happen?
No.
Right. That's what I'm saying. It's like, it's crazy what's happening right now.
It's a weird economy, right? It's just weird. You get so many cross currents, and you can make the arguments. I mean, I think just if you pull back, right, just zoom out, like we say, the clear trend is that the sugar high from the fiscal stimulus is wearing off every week, every month that goes by. Credit conditions are tightening and the economy is decelerating. So you have to believe that eventually the fundamentals follow that. Now, how long that takes, the timing of that, whether the market perceives indications or indicators on a daily basis incorrectly, it's really tough, right? Timing's everything. But I think you can expect that this isn't going to get resolved by the end of the year. This is a 2023 story. So when we were having those podcasts earlier in the year, I'm like, this can take time. Like, this is not something where the credit markets can implode this summer. It might be a 2023 story. Emerging markets blowing up might be a 2023 story. I think that's what you're seeing.
Guys, let's wrap it up there. Go around the horn. Jeff, tell people where they can find you. Anything else you want to highlight? We'll have it all in the show notes, but go ahead.
Sure. So I'm most regularly on Twitter. My handle is @VailshireCap. If you guys want to learn more about how I invest, I obviously do things pretty differently than most financial planners and investment advisors. You can look up my website, vailshire.com, or if you're curious about my services, shoot me an email, info@vailshire.com.
Joe?
Yeah, Joe Carlasare. I'm @Joe Carlasare on Twitter. I'm a commercial litigator with the law offices of Smith Amundsen. Hang out on Twitter, easiest place to find me. Always shoot me a DM if you have a question, and thanks for the follows.
Jay?
For the next 4 weeks, you can find me at Tyson Shoal and Seaside Heights on my boat, my jet skis, and my kids.
Nice.
No, you can find me at Jay Gould on Twitter, and most of my handles on most of the social media is the same. Angel investor. So if you're a startup in Bitcoin or otherwise, hit me up if you're a tech founder.
I think people can tell during these discussions that we are truly trying to figure it out, right? Like, for ourselves. Like, there's no we're not trying to push any one narrative. We're just truly trying to find reality and what we think where the probabilities are going to be kind of moving forward. And what a blast doing this with you guys every quarter. I just can't thank you enough for making time and to spend basically the whole evening here just kind of hashing it out. I always have a blast during this. So guys, thanks so much for making time.
Thanks for having us, Preston.
Thanks, bro.
Yeah, thanks, Preston.
The risk here is more so that your funds are inaccessible for a brief amount of time. And the fact that this is, a risk that isn't even having anything to do with lost funds, it just goes to show, like, we're reaching to try and find risks that are on the Lightning Network. Whereas in traditional capital markets, right, let's say you move your way up the risk curve to something like venture capital or equities, there's far more associated risk with that. There's far more associated risk with, other cryptocurrencies.